All right, let's dive into something really fascinating today. We're going to pull back the curtain on a specific and honestly pretty controversial theory about how financial markets really work. It's called the ICT methodology, and it's built on the idea that behind all the chaos on the charts, there's a hidden logic, almost like a blueprint.
So this is the big question that kicks everything off. I mean, most of us are taught to believe the market is just this random, unpredictable force, right? Driven by news and emotions and herd mentality. But the whole ICT approach starts with a really provocative question. What if that's wrong? What if the price swings we see day in and day out are not random at all?
And this is where we get to the core philosophy. The inner circle trader method, which was developed by Michael J. Huddleston, makes a bold claim. It says the market is the absolute opposite of random. The idea is that markets are actually meticulously engineered, that the price action you're watching is a carefully constructed story written by the big financial institutions.
Now this really shows you the fundamental mindset shift. You see, a typical retail trader sees a price moving up and they chase it, right? They hop on the trend. But the ICT philosophy says the big institutions aren't chasing a thing. Instead, they're actively hunting for one specific resource that fuels the entire market, and that resource is liquidity.
So what exactly is this liquidity they're after? Well, to put it simply, it's just big pools of buy and sell orders. Just think about all the stop-loss orders that traders, just like you and me, place right above a recent high or just below a recent low. Those orders are like fuel for the market. And according to this theory, institutions will intentionally push the price to those levels just to trigger all those stops before they move the price in the direction they really wanted to go all along. So this breaks it all down into a really simple three-part logic. First, you have to wait for the manipulation. That's the move to grab all that liquidity. Then you look for confirmation, a clear sign that the market is turning around. And only then, after those first two things happen, do you find your entry. See, it's not about trying to predict the future. It's about reacting to a very specific sequence of events.
Okay, but here's where it gets even more specific. And for me, this is kind of fascinating. This whole market engineering thing, it doesn't just happen whenever. It actually runs on a pretty strict schedule. In this system, timing is absolutely everything, because the institutions behind these moves are most active during very specific windows of time.
And this right here illustrates that daily rhythm perfectly. So you have the Asian session, which is usually pretty quiet, right? It's a period of accumulation where orders just start to build up. Then, the London session often delivers the manipulation, that liquidity sweep we just talked about. And finally, the New York session is where you tend to get the real expansion, the big, obvious move of the day. And to zoom in even further, ICT traders really focus on what they call kill zones. Now, these are very specific windows, you see them here in New York time, where the highest volume and institutional activity is happening. You've got the London kill zone from 2 to 5 a.m. and the New York kill zone from 7 to 10 a.m. These are the absolute prime time hours to be watching for these high-probability setups to take shape.
So let's recap. We know what we're looking for, that liquidity, and we know when to look for it inside those kill zones. So now, let's get into the how. This whole methodology is really built around three core entry patterns that basically make up the ICT trader's playbook.
The first one, and probably the most classic setup, is the liquidity sweep. So you find an obvious old high or low on your chart where you know stop orders are probably resting. Then you just watch and wait for the price to aggressively smash right past that level. But here's the key. You don't chase it. You wait for it to be immediately rejected and start reversing. That sharp reversal is your signal that the manipulation is over, and that's your cue to enter.
Now, before we hit the next setup, there's a key concept you have to get, and it's called displacement. This is not just any old price move. We're talking about a powerful, energetic, one-sided move, like a single big candle or a few in a row that just slice through a price level. It's basically the market showing its hand. It's a clear signal of institutional force and their true intention.
And that leads us right into our second setup. When you see one of those powerful displacement moves, it often happens so fast that it leaves behind an inefficient little gap in the market. So the setup here is actually pretty simple. You wait for the price to pull back or retrace right into that gap. The theory is that the market will come back to that area to sort of rebalance the price before it continues on its way. You're basically getting in on the institutional footprint.
Our third setup is all about getting down to surgical precision.
Here, you're looking for the one specific candle, what's known as an order block, that was responsible for kicking off that huge displacement move. It's the origin point of that institutional push. The trade is to patiently wait for the price to come all the way back down to that exact candle, and you enter only after you see the price react to it in a supportive way.
So, we've got the theory, we have the timing, we have the playbook of setups, but how do you actually avoid the bad trades and focus only on the absolute best opportunities? Well, that's where having a really clear checklist or a quality filter is so important.
This is all about filtering for A-plus setups. A high-probability trade has to check all the boxes. Has liquidity been taken? Yes. Was there a strong clear displacement? You bet. And did it all happen inside a kill zone? Absolutely. On the other side, you want to avoid that weak, choppy price action that's stuck in the middle of a range during a dead session. This checklist is really your guide to staying disciplined.
And of course, none of this matters without proper risk management. A core rule here is to only take trades where your potential reward is at least twice your potential risk. This is so important because it ensures that even if you're not right every single time, your wins can more than make up for your losses over the long haul.
And really, it all boils down to this one powerful idea. It's not about being in the market all the time. It's about being in the market at the right time, with a precise reason for getting in. Just as the founder of this method says, precision plus timing equals profitability. So look, whether you end up being a believer or a skeptic, the ICT methodology offers a really structured, rules-based way to look at the market. It suggests that underneath all that noise, there's a repeating pattern of manipulation and expansion. And it really just leaves us with one final question. Now that you've been shown the pattern, can you unsee it?